Greetings of the day. Today, we shall discuss on intellectual property, GST, ROC filing, and compliance for startups in India. Strong compliance around intellectual property tax and company law helps a startup protect its innovation, build trust with investors, and avoid penalties during growth and funding. A founder who understands IP, GST, and ROC requirements can design processes that keep the company legally sound while the team focuses on product and customers. Intellectual property for startups. Intellectual property or IP includes the brand technology content and confidential know-how that differentiate a startup from its competitors. In India, three primary statutory regimes matter most for early stage ventures: trademarks, patent, and copyright, with design protection relevant for physical products and fashion ventures. Trademarks protect brand names, logos, taglines, and even distinctive packaging that identify goods or services in the market. For a tech or consumer startup, this means securing the startup name, and the main product labels early so competitors cannot free ride on the brand or confuse the customers. Patents protect novel inventions and technical processes, including software inventions that satisfy novelty, inventive steps, and industrial application. That is the requirement under the Patent Act of 1970. Copyright safeguards original literature and artistic works such as source code, marketing content UI images, videos, and product manuals, which arise automatically on creation but benefit from registration when enforcement is needed, according to Startup Movers 2026. Founders should treat IP not as a mere formality but as a core strategic asset that investors closely scrutinize at the time of seed and series of funding, according to Corridor Legal 2025. A practical rule of thumb is to complete core IP registration or at least filings within the first 12 months of operation, especially for the brand and any patentable technology. DPIIT recognition under Startup India can reduce IP filing cost and enable fast track examination of patents and trademarks, which is valuable for startups operating in contested or fast moving markets. A critical but often ignored dimension of IP is ownership of work created by co founders, employees, freelancers, and technology vendors. If the startup does not use robust contracts, IP may legally remain with the individual creator, which can derail funding or an acquisition later. Standard founder and employment agreements therefore include IP assignment clauses, confidentiality obligations, non competent and non solicitation safeguards, and clear treatments of residual rights so that all relevant IP vest fully in the company. GST registration and compliance for startups. Goods and Services Tax, or the GST, is the unified indirect tax on most goods and services in India, and registration becomes mandatory once a startup meets certain turnover or business model thresholds. In general, businesses supplying taxable goods must register when annual turnover crosses around 40 lakh rupees, while service providers and special category states have lower limits with compulsory registration, also triggered by interstate supply e-commerce operations or status as an online platform. Many startups opt for voluntary GST registration below the threshold because it improves credibility with B2B clients and allows input tax credit on expenses such as cloud services, rent, and professional fees. The registration process is fully online through the GST portal where founders submit PAN business details, authorized signatory information, and proof of address and bank accounts along with digital signatures for companies and the LLPs. Once approved, the business receives a GSTIN which must be displayed on invoice and often at the place of business and used for all subsequent returns and payments. After registration, ongoing compliance typically includes issuing GST compliant tax invoices, maintaining detailed records, filing monthly or quarterly returns such as GSTR1 and GSTR 3B, and reconciling input tax credit with vendors filing. Non compliance with GST can quickly create compounding risk through interest penalties and possible cancellation of the registration. Common errors include delayed registration even after crossing thresholds, failure to issue e invoice where mandated, and mismatch between reported outward supplies and actual collections, which can lead to notices. Recent changes for 2025 emphasizes stronger authentication, multiple factor login, tighter timelines, and expanded e-invoicing for more categories of taxpayers. So founders should periodically review GST updates with their CA or tax advisor. A simple internal control is to fix a monthly compliance calendar with a buffer of a few days before statutory due dates and link it with accounting software reminders. ROC filing and company law compliance. Registrars of companies or the ROC filing under the Companies Act of 2013 apply to startups incorporated as private limited companies and to LLPs with some such variations. These filings create an official record of the company's financial governance and capital structure and are closely scrutinized by investors, banks, and regulators. While penalties have been relaxed for some small companies, MCA still treats persistent non filing as a serious offense, which may result in heavy additional fees, disqualification of directors, and even striking of the company. For a typical private limited startup, annual ROC compliance includes holding a board meeting to approve financial statements, conducting an annual general meeting, and filing key forms as AOC4 for financial statements and MGT7 or MGT7A for annual returns within 30 and 60 days of the AGM, respectively. Directors must also complete DIR 3 KYC annually to keep their DIN active, while forms such as DPT 3 for deposits and MSME 1 for delayed payments to micro and small vendors apply when relevant. LLPs have their own compliance form, such as LLP Form 8 for statement of account, and solvents and LLP Form 11 for annual return. Through the core idea of timely disclosure remains similar. Beyond these annual filings, many startup actions trigger event-based ROC compliance. Typical events include allotment of new shares, changes in authorized capital appointment, or resignation of directors, shifting registered office, or creating a charge in favor of a lender, all of which requires specific MCA forms within a defined timeline. With funding rounds and ESOP plans becoming more common even at seed stage, founders should align their cap table management with company law requirements so that even share issue is fully documented and reflected in the ROC records. Relaxation introduced in 2005 for small companies focus on reducing filing burdens and simpler formats but do not remove the duty to file core documents on time. Integrated compliance mindset for startups rather than treating IP, GST, and ROC as isolated domains. Successful founders build an integrated compliance mindset from incorporation. This means mapping all mandatory registrations and filing on a master compliance matrix, assigning clear internal owners, and using automation or professional partners for tracking deadlines. Many modern startups deploy HRMs and finance tools for EPF, ESI, payroll, and tax records with similar systems or outsourced company secretarial support used for ROC and board documentation. Periodic compliance audits at least once a year help identify gap in tax, labor, IP, and corporate law adherence while there is still time to correct them without severe penalties. For DPIIT, recognized startups, the benefits go beyond branding to tangible incentives such as inspection relief under labor law, faster IP processing, and easier access to government tenders, but these advantages require that baseline compliance stay in order. A useful approach is to review the compliance before major milestones such as funding rounds, product pivots, and expansions into new states or countries, since each such event often adds fresh obligations around data protection, export controls, or sectoral licenses. Now, let's look into a case study. Imagine a Bengaluru based SaaS startup called Data Hive Analytics Private Limited, founded in 2023 to provide AI powered dashboards for mid sized manufacturing firms across India. The company, incorporated as a private limited entity, raised a small seed round from angel investors and crossed annual revenues of 60 lakh rupees by mid 2025, offering both subscription software and custom data consulting services. Intellectual property decisions. From inception, the founders treated their platform algorithm and brand as central asset and consulted a startup focused law firm to design IP strategy. They chose a distinctive name, Data Hive, and filed a trademark application in Class 42 software as a service within 6 months of launch, ensuring protection against the copycat analytics services using similar branding. At the same time, they documented their core AI based forecasting workflow and, after a prior art search, filed a provisional patent application to secure a priority data while they refined the technology. The law firm also redrafted all founders and employee agreements to include comprehensive IP assignment, confidentiality, and non solicitation clauses so that all algorithms code and client specific models created by the team unambiguously belong to the company. When they onboarded a freelance UX designer and the third party cloud consultant, they used similar contracts which prevented further disputes about ownership of the dashboard, interface, and deployment scripts. This early focus on IP ownership impressed a later institutional investor who noted the clean IP chain of title during the due diligence. GST registration and practice. Because Data Hive Analytics quickly started serving clients in multiple states through fully online delivery, and founders opted for GST registration even before they crossed the mandatory threshold. They applied on the GST portal with PAN incorporation, certification bank statements, and the digital signature certificate and received their GSTIN within about a week. The company implemented standardized tax invoice with GSTIN, HSN, SAC codes, and clear breakup of taxable value and tax, which made it easier for corporate clients to claim input tax credit. Initially, the team underestimated the complexity of monthly GSTR1 and GSTR3B filing, and they experienced a 1 month delay which triggered late fees and interest on tax dues. In response, The founders onboarded a CA firm, integrated their invoicing software with the GST system, and created an internal monthly schedule requiring all sales data to be logged 3 days before the filing deadlines. When e invoicing became mandatory for their turnover, the category in 2025, the startup adopted an API based e invoicing provider early and trained its account staff on the new workflow, avoiding disruption and client dissatisfaction. Within a year, compliance became routine, and the company used GST data to analyze customer segments and payment cycles, improving working capital management. ROC filing and governance. As a funded private limited company, Data Hive Analytics worked with the company secretary to manage the ROC filing and board governance. After its first financial year, the company held a board meeting to approve audited financial statements, then convened its annual general meeting and filed AOC 4 and MGT 7 within the prescribed 30 and 60-day timelines, respectively. The directors completed the DIR, 3 KYC, and updated registers of members and directors, which kept the company's MCA record clean and accurate. When the startup raised a second seed round in 2025 and expanded its employee stock option pool, it executed proper share subscription agreements, issued share certificates, and filed the relevant forms for allotment and change in share capital with the ROC within the required period. At the same time, it filed MSME 1, disclosing occasional delays in paying its smaller vendors, which helped the founders monitor working capital discipline. During the due diligence, the new investors appreciated that ROC filing matched the cap table and investment documentation, which reduced negotiation friction and legal cost. Let's look into the outcome and lessons. By early 2026, Data Hive Analytics had grown to over 1 crore rupees in annual recurring revenue with a stable base of clients and interest from a strategic acquirer. The company's early investment in IP, trademarks, and provisional patent ensured that its brand and the algorithm were clearly protected and fully owned by the company, making it easier to negotiate valuation based on its intangible assets. Consistent GST compliance meant there were no outstanding tax disputes or large contingent liability, and structured ROC filing gave investors and the acquirer confidence in the legitimacy of its governance and capital structure. This case illustrates that compliance, when treated as a strategic function rather than a reactive core, can directly improve fundraising outcomes and exit readiness. For other Indian startups, the key takeaways are to secure IP ownership within the first year, choose timely GST registration within disciplined filing, and maintain clear ROC records through professional support and regular internal reviews.